Is Bitcoin really going to 1 million or 10 million? Well, actually, I'm going to tell you why I think that's actually bearish. Now, this isn't some hypothetical. I'm going to show you how. 5 times over the last 300 years, this exact process has played out. I'm here in Bitcoin Mina. This is the capital of capital. I'm talking about Abu Dhabi. I'm about to go on this stage. I'm going to show you exactly where we're at right now and the blueprint of how we progress through 2030, 2040, and ultimately 2050. If you want to know exactly where we're at and how to navigate this, stick with me as we go up on stage and break it down.
Bitcoin was always coming for everybody. This is not just a new technology. This is a revolution. There is no end to the monetary debasement that's coming. That would put Bitcoin at a 21 trillion market cap. $1 million per Bitcoin. At that point, the dollar doesn't buy anything. No, that's absolutely not right. And this is where Bitcoin evolves beyond just a financial asset. You no longer measure your wealth in fiat, you measure your wealth in Bitcoin. And at this point, puts Bitcoin to about $400 million per Bitcoin. Are you going to take advantage and help lead this revolution? Or are you just going to watch it pass by?
Please join me in welcoming Mark Moss from Market Disruption.
All right. Now, in order to understand where we're going, let's just jump and look into the future for a second. Let's imagine that we're in the year 2050.
Bitcoin isn't priced in dollars, euros, yen, or dirham anymore because at this point, these currencies don't matter. Global trade is now happening in Satoshis, sovereign nations are now settling in Bitcoin, and your wealth is denominated in Bitcoin at this time. 1 Bitcoin equals 1 Bitcoin, and the world has changed. This isn't some wild fantasy, this isn't some speculation. What I'm going to break down for you right now is I'm going to show you how this same historical pattern has happened 5 times over the last 300 years, and it's a repeatable pattern, a predictable pattern that gives us a blueprint to follow along. What I call a quantum leap. Now, this is a point when technology changes the rules of the game, it changes the way that we work, interact, and live in the world, and the rules change, the balance of power is shifted forever, and the way that we view the world, we interact in the world has changed. Now, as I said, this happens on a 50-year time frame. Since we had the birth of the Industrial Revolution in the mid-1700s, each one of these represents a time when the entire world completely changes. What I'm calling a quantum shift. We had the Industrial Revolution. About 50 years later, we had steam engines and railways. About 50 years later, we had steel, heavy equipment. We had electricity. About 50 years later, we had automobiles, oil fuels, mass production. About 50 years later, we had the birth of the microprocessor, which brought birth to the telecom, the personal computer, and the internet. Now, one thing to keep in mind with this is that this is not about one new technology. This is about a cluster of technologies that come together to give us a new set of building blocks to build things that we can't even imagine today. Humans are no good at imagining the future because all we can do is imagine a better version of what we have. And now we're going into what I'm calling the 6th revolution. This is the 6th time we've seen this cycle repeat in what I'm calling the decentralized revolution. Now, it's not just that the world completely changes from the technology, which of course it does, but it drives all financial markets. The only place to invest for the last 50 years has been the internet and personal computers and telecom. And before that, it was Ford and GM and GM. Before that, it was oil and it was steel. Each one of these cycles represents a new set of generational wealth. And each one of us right now are sitting at this point where we have the ability to create generational wealth as this cycle unfolds. Now, as I said, each one of these cycles that's happened 5 times, now we're on the 6th, has a repeatable process and is broken down into 4 stages. Now, the first stage is what we call the eruption phase. Now, we have the Big Bang, which is where the new invention came. And there's a lot of excitement about it. And there's some people who like to tinker, the nerds maybe. They like to play with it. And we have this eruption that happens in this Big Bang. Now, it's worth noting that this is because the previous 50-year cycle is starting to die out. And we have a new bang, the Big Bang, that takes off. Now, this is the eruption or the emergence of this 50-year cycle. The second phase, I went ahead and put a green line here, shows sort of where I believe we are right now, which is the frenzy phase. Now, this is about speculation in this phase. This is the emergence of this cycle. Then we go to phase 3, which is the synergy phase. This is really where we start to see integration of these new technologies into society. And then finally, we have the 4th phase, which is maturity. This is where the global standardization happens, and the next great great surge begins. So now you have sort of like a little bit of a framework of what I'm talking about. And the old system that we have dying are these centralized systems. And so the last cycle, which we talked about, telecom, personal computers, internet, has started to die. The internet has lots of problems, lots of centralization, and so now we have a decentralized wave that's starting to take off, giving us a new set of protocols for money, for communication, and other things like that. And this is why I'm calling it the decentralized revolution. Now, each of these 4 phases, as I said, are very predictable, and we can map out this decentralized revolution, and we can overlay Bitcoin perfectly to this. So it gives us a perfect example, and we'll break down exactly where we'll be in 2050. As I framed in the beginning, this is not some hypothetical fantasy that, of course, we're all dreaming and believing in, but instead, history shows us this is what the reality will be. All right, now one more thing I want to overlay is it also overlays perfectly with money. If you go back through thousands of years of monetary history, you'll understand that money, as we know it, is both evolutionary and emergent. So it goes through 4 phases. Anybody read Safeteen's book, The Bitcoin Standard? You might understand some of this. So we've had lots of forms of money, from feathers, rocks, and seashells, and eventually gold emerged. And it goes from a collectible phase. Oh, look at this cool rock. Look at this cool feather, this cool seashell. Let's collect it. Now, some things, obviously not all of them, some collectibles could evolve to the next stage, which becomes a store of value. Now, in this store of value phase, we see this today. Lots of wealthy people store their value in collectibles, fine art, old cars, paintings, Pokemon cards, baseball cards, whatever that may be. Now, if some of these store of value assets have the right qualities, most of them don't, to be money, then it could potentially evolve to the next stage of medium exchange. Now, it has to be portable, divisible, durable, recognizable, etc. A Mona Lisa could not make a medium exchange because, of course, you can't divide it. A cow could be divided, but it's not fungible parts for parts. So if we have the right attributes, we can go to the medium exchange. And then ultimately, if we've met all of these levels, we could go to the unit of account. So this overlays perfectly with technology. So we're witnessing all of this at one time. So let's just break down. Let's jump into the past real quick. Let's just recap where we're at. Phase 1, which is eruption. This is from 2010 to 2020. We're going to go pretty quick through this. So in this phase, again, this really is represented by retail adoption. All right, in this first phase, it's defined by the same challenges, though, as every other one of these revolutions in history, which is the technology is limited by scalability. All right, when automobiles were introduced, for example, within 3 years, there's 250 manufacturers, but they couldn't scale. There was no roads, no gas stations, no tires. The internet was out for over 20 years. By the year 2000, after the dot-com boom, less than 10% of people had bought anything online because the internet was too slow and it couldn't scale. The same thing we saw with Bitcoin. It was hampered with scaling solutions, which is exactly what's supposed to happen in the first phase, which led to other things like altcoins, but we'll get back to that in a second. Now, this overlaps perfectly with money. So in this first phase, 2010 to 2020, Bitcoin is in this collectible phase. Now, we can see some illustrations of this. We had famous Laszlo spending 10,000 Bitcoin on a pizza back in 2010. So this Bitcoin, this collectible, what is it? Let's see what we can do with it. Would anybody trade me one collectible for another? How about some pizzas? It was a groundbreaking experiment. Of course, it was a very expensive pizza looking back in it. But remember, each one of these cycles is held back by scaling. And so in this scaling, then we had this experimentation into this altcoin boom. Well, let's make ones that are faster and cheaper and more private. But this is one piece that's always there present. It was a necessary step. Now, I believe that this collectible phase really headed up in 2020, and we can see where this really took a blow off top with NFTs, the ultimate collectible. The NFT market exploded in 2020, growing 300%, over $250 million in transactions. 97% of wallets were using them, but by 2021, it got to 41 billion, as you can see. By 2022, it completely fell off a cliff. Trading volume dropped 97%, and today, reports are that 99% of NFT projects are dead. So the collectible phase was a necessary step, but it's not the future. Now, we can see that going into phase 2, which is then the store of value phase, the seeds were already planted early on. We saw early back in 2013, venture capital fund Andreessen Horowitz already started to invest into Bitcoin startups, trying to help build that next stage. We saw 2017, CBOE and CME started doing futures. That was really the first time we started seeing institutional adoption coming in for the store value. 2018, Fidelity started planting the seeds to get other institutions in as well. And so that's where it phased. Now, looking at some of the prices, we can see in 2010, these on the left are store of value assets. So these are assets that we store our wealth in, obviously. Real estate, gold, collectibles, equities, real estate. Now, gold was only a $5 trillion asset in 2010. By 2020, it was $11.5 trillion. Real estate was about $180 trillion. By 2020, it was $326 trillion, growing at a 6% ARR. Now, during this time, all store of value assets went up by about 8%. ARR, Bitcoin went up 4,426%. Amazing time to be in Bitcoin. During that time, we can see that Bitcoin went from about 30 cents for a Bitcoin to $28,000. Again, an ARR of 4,426%. Now, during this time, Bitcoin, by 2020, took about 0% of store of value assets. Not even a blip, not even a drop in the bucket. Okay, now let's get into some of this future, okay? Now, phase 2 is what we call the frenzy phase, and this is where we're at today, all right? This is gonna be unlike anything we've ever seen, and no matter how bullish you are, you're not bullish enough. Now, this is where Bitcoin evolves from the collectible phase and cements itself as the premier store of value. We're in this institutional frenzy phase, and we're starting to see institutional adoption come in, and now, of course, here we are talking about sovereign adoption that both happen in this phase. Now, this maps, again, in the evolution of money, and will complete the store of value phase. But this is where we're at today. Now, again, not all collectibles make it to this next level, but Bitcoin will. Now, I do want to point out real quick, for everybody who thinks that they're too late, that maybe they missed it, using an S-curve dynamic is how we'll look at technology adoption. Now, one way we can look at this S-curve is that the time it takes to go from 0 to 10% is the time it takes to go from 10 to 90%. And the reason why I want to show you this is because it illustrates that the size of this move we're going into now is much larger. Sure, today Bitcoin is about a $2 trillion US dollar market cap. Hundreds of billions of dollars have gone into it, and now we're about to see trillions of dollars come into it. The size and speed of the move is much bigger, so you haven't missed anything, it's just getting started. Now, at this point, we can see this total store of value assets. You can see Bitcoin down here on the bottom right, sitting today at about 2 trillion, and it's still just a little blip on the road right here. A drop in the bucket. Now, how much bigger is it going to get? Well, I got a bunch more charts to show you, so don't worry. But really, right now, this is the frenzy. This is the institutional phase. We can see that right now today, about 60 companies have already started adopting Bitcoin on their balance sheet, and this is happening every day. We see new announcements of this happening. This chart, the big chart here, shows the real institutional adoption. We have MicroStrategy adding about $1 billion a week. I just saw before I went on stage, Riot just added about $500 million of debt to buy Bitcoin. We have Marathon doing $1 billion. And right now, this is showing us that about 13.5% of all Bitcoin is now being held by institutions. Of course it is. Bitcoin was always coming for everybody, and this is part of the second stage. Now, it's not just institutions, it's also sovereign adoption. We have sovereign FOMO. We have, of course, El Salvador, sort of with this first mover advantage. Brazil, just introducing bills to build a strategic reserve. Of course, the United States has their Bitcoin bill going through. Now, per Polymarket, I looked earlier today, it's about a 25% chance of going through. I think that's way too low. I think it's going to be much higher. Now, history shows us what happens when sovereigns start competing. History shows us a lot of things. So, for example, in the 1800s, the entire world decided to go to a gold standard. Some parts of the world, like China, didn't want the gold standard. They had silver. They wanted to stay with silver, and they lost their position as a world leader. We saw the 1950s, the race for space. We saw the race for nuclear weapons. When nations start competing, things really take off. So we have a precedent for where this is going. But why? Why are the institutions FOMOing in, racing into a new asset? Well, because they see what we all should see. They see that there is no end to the monetary debasement that's coming. And they're all looking for a way to protect themselves. what we have right here is that we can see the bottom right is the U.S. Federal Reserve's balance sheet, which has been expanding by 13% a year over the last 4 years. We can see the money supply has been averaging over 8.5% over the last 4 years, and there's no end in sight. How do we know there's no end in sight? Well, besides the fact that they're in a debt-based monetary system that always has to grow, the government actually tells us that. We can look at the CBO, Congressional Budget Office, and we can see that they are projecting through 2054, the next 30 years for us. And they show us that the deficit spending is going to get bigger and bigger and bigger. They show us that the debt levels are going to go up like a hockey stick. And they also show us that population growth on the top right is going to plummet as the GDP goes down at the same time. Population growth going down, GDP going down, means debt levels go up. Now, they also show us the budget through 2054, 30 years from now, and there's no recession in sight. They don't expect any dip in the revenue coming in. So, where does all this come from? Money printing. Now, of course, this is what they tell us for the next 30 years. When you look at the population decline and the GDP decline, I think this is way understated. But for the purpose of what we're doing, we're going to use these numbers and project it out into the future. So in this phase from 2020 to 2030, using the numbers that we have from the last 4 to 5 years, we can project out the money supply growth at 8% continuing, bonds going up 5%, real estate and equities, which are basically perfect proxies for monetary debasement, going up at 8%. Bitcoin maybe finishing the decade at about a 53%. We're at about 60% right now. That would put Bitcoin at a 21 trillion market cap. $1 million per Bitcoin in the next 5 years, or a 10x from right here. Now, this may sound like a big number, but if we look at it, Bitcoin is only capturing 1.5% of total store of value assets at the point. Now, if it was able to get 5%, which might be way more reasonable, that puts Bitcoin at a $3 million price per Bitcoin. So I believe 1 million is extremely bearish and not bullish at all. Now let's just keep going. If we look at it as a percentage of store of value assets, just so you can visually see it a little bit better, you can see that now Bitcoin is about on par with gold. Maybe it's overtaken, it's flipped gold by this time. Now it's one point that I want to bring out right here real quickly, is a lot of people think that for Bitcoin to be worth 1 million or 5 million or 20 million, well, the dollar's worthless, right? At that point, the dollar doesn't buy anything. No, that's absolutely not right. You see, Bitcoin is disrupting other assets. I have a venture fund called the Bitcoin Opportunity Fund. As a venture investor, we look at a disruptive technology, we look at the size of the markets it's disrupting, and then we speculate as to what percentage we think we could take from those other markets. So Bitcoin is taking from bonds, it's taking from real estate, it's taking from equities. The dollar doesn't have to die. Sure, gas goes from $4 to $8. It doesn't mean it goes to zero. Now, is that realistic to get 1%? Well, we can look at other disruptive technologies like Uber or Airbnb. Both of them were able to capture 10% of their market in less than 10 years. 1.5% is extremely conservative. All right, now let's start going into the future. Now we're getting into what's called the deployment phase. This is 2030 to 2040. Now this is where things start getting really exciting, but warning, I have to leave some historical numbers behind, and I got to start using my crystal ball. This is the adoption and the synergy phase. Now, this is where things start getting really exciting. We start to see adoption. Some interesting things about adoption is a lot of Bitcoin critics want to tell you that Bitcoin's already failed. It hasn't achieved any adoption. Why is it in a medium of exchange, they tell you? Why can't I just go to the store anywhere and spend my Bitcoin, they ask. Well, I'll tell you why. Because history gives us a framework and tells us that it doesn't come until the next phase. And anyone who's expecting that right now doesn't understand technological revolutions. They don't understand monetary history. They don't understand that there's this evolutionary and emergent process that we have to go through. And what they also fail to understand is that even though Satoshi called an electronic cash system, they say it's failed because it's only a store of value, they fail to understand monetary history and something specifically called Gresham's Law. Gresham's Law says that bad money drives out good. Bad money drives out good. So what that means is we're always going to want to use the bad money, not the good money. As long as I can use fiat currency to buy my lunch, buy my drink at the bar, I'm going to use the fiat currency and I'm going to save the good money, which is the Bitcoin. Why would I spend the good money? Now, we have a perfect way to understand this. In the United States, of course, we have coins and we have quarters and dimes. Up till 1965, these were made out of pure silver. Starting in 1965, they made them with junk metal. That's nickel and copper. You cannot find in America a pre-65 quarter or dime in circulation. They're all gone. They were driven out. If you just so happened to get some change and you found a pre-65 quarter and dime, you would not spend it. Why? Because a quarter now is worth $4, but you'd only get 25 cents for it. The bad money, the worthless quarters and dimes, have driven out the good ones. You wouldn't spend those. And so it's a perfect illustration. Now, why would we then use Bitcoin as a medium of exchange? Well, we would only use Bitcoin as a medium of exchange if it could do something that the existing money, the fiat system, could not be used for. Now, we can use this as another example. Gold collectors buy bags of what's called junk silver because they believe that at some point the fiat system crashes and they're going to need the quarters and dimes in small denominations to barter with. They believe in a world where the other money, the fiat money, no longer works, and they would need that money, which illustrates the point. So then we ask ourselves, well, what would we need Bitcoin for that fiat would be no good for? Certainly not to buy the drink at the bar. Works fine for that, my plane ticket, make my house payment. So what kinds of things? Well, we look at the unique utility abilities of what Bitcoin can do. It's fast and cheap, it's borderless, it's permissionless, it's censorship resistant, it's immutable. So if we need to do those types of things, then we might want to use Bitcoin. Well, certainly, I guess, in authoritarian regimes, maybe North Korea, Afghanistan, where they censor transactions, maybe we could do it there. But where I think the real use case comes, and it's coming really fast, and we're talking about right now, is the ability to do microtransactions that are both fast and cheap. Now, what type of microtransactions being done fast and cheap in a borderless way, in a permissionless way, would we be looking at? Well, anybody heard of the rise of AI? More specifically, AI agents. Now, AI agents are the ability to build an AI bot to be autonomous and go do tasks, transactions, and maybe even build entire businesses by hiring other agents autonomously. Now, these AI agents are growing rapidly. Within the next couple of years, they will be completely taken over. As a matter of fact, we can see that by 2040, they're expected to grow by over 40% compounded annual growth rate. And these AI agents can't have a bank account because they're not a person. They can't pass KYC, but they can have a Bitcoin wallet. These AI agents can hire other AI agents and pay them microtransactions. Why micro? How much does it cost to hire an AI agent? The cost of power and compute. How many times will they need to transact? Hundreds, maybe thousands of times a day. And fiat currency won't work for this. And this is all coming really fast, and I'm talking in the next couple of years. This is where Bitcoin becomes indispensable. It enables a new era of autonomous collaboration. Now, this isn't just me saying it. If you haven't been paying attention, it's all over. But Elon Musk says that by 2030, robots and autonomous systems will dominate the 2030s. He says that they're going to overtake humans. You'll be able to buy these things for $20,000. Everyone's going to have them. Autonomous taxis, autonomous robots, and they'll all be running off of Bitcoin. It'll be their economic backbone. Where fiat fails, microtransactions, high fees, the need for permission, that's where Bitcoin will thrive. Just like electricity transforms cities, Bitcoin and AI together are going to power the next great economic revolution. Now, in this phase from 2030 to 2040, where we get the deployment, Bitcoin goes from a $21 trillion market cap to almost a $300 trillion market cap. Now, we're not talking about 4,000% compounded annual growth rate or ARR like we saw in the past. We're talking more of a modest 30%. If real estate and equities are still going up by 8%, if the money supply is expanding more than that, Bitcoin is going to be at least doing 30%, which takes it from 21 trillion to 300 trillion, or puts it at about a $14 million price per Bitcoin. Now, by then, Bitcoin would be worth, like I said, 14 million. It's going to dominate the global store of asset value stage. And if we look at this visually, we can see that it's now taken over collectibles and gold, and it's now catching up to the money supply. Still a little bit behind equities, but it's catching on quick. You guys want to see where we're at in 2050? All right. All right, here we are, phase 4. Now, this is the maturity phase. This is covering, again, 2040 to 2050. And this is where Bitcoin evolves beyond just a financial asset. This is where it becomes something even bigger. So let me go back to my crystal ball one more time, see what we got. Okay, so we're in the maturity phase, and the maturity phase is where Bitcoin finally becomes a unit of account. This is where, as we've seen throughout history, using this repeatable framework, we've evolved to the final stage of a unit of account. Now, this maps over perfectly by this phase. Bitcoin achieves this role as this global unit of account. And we start to see things that we haven't seen before. So, for example, in this maturity phase, we start to realize that life's getting easier. Life's not getting more expensive. Life's getting easier. Life's getting cheaper. I have to work less to achieve the same lifestyle I had before. So, for example, in 2016, homes cost, on average in the United States, $288,000, or 664 Bitcoin. Today, the median home has gone from $288,000 to $434,000, but it's only 4 Bitcoin. Life is getting easier. Bitcoin flips the script on that. But it's not just homes. We can see all financial assets. Oil, gold, the S&P 500 in the last 5 years have dropped almost 90% when priced in Bitcoin terms. And it's not just financial assets. Agriculture, eggs, cheese, beef, wheat, lumber, everything that we need to live dropping by 90%. Priced in Bitcoin. This is what a Bitcoin-denominated world looks like. It's not just about cheaper goods. It's about a world where life gets easier for us. It's about where your money works for you. Now imagine a world where your money gets stronger every year. Imagine a world where your money buys you more goods and services in the future instead of less. A world where actually we're seeing innovation thrive, and again, life getting easier and not harder. Now, under this Bitcoin standard, we can actually start to see the reality of AI and robotics and energy all working together to reduce the cost and expand access, creating massive amounts of abundance. Now, this is in a Bitcoin-denominated world. As Jeff Booth laid out earlier, this cannot happen in a fiat world. The systems are incompatible. The only way that we achieve this is with Bitcoin, and of course, everybody wants this. Now, in this phase, the maturity phase, I'm predicting, again, using what the Congressional Budget Office has shown us through 2054, that the money printing continues. Global store of assets have gone from $3.5 quadrillion to $8.5 quadrillion, which sounds absolutely crazy, but again, my parents bought a home for $40,000. I mean, that's how crazy this world is. Now, money is still there, bonds are still there, real estate, equities, collectibles, gold, all of those things are there. Bitcoin is now slowed down to about a 20% ARR. We're not talking crazy numbers. We're not talking a 4,000% ARR. And Bitcoin has gone from a $289 trillion to now a $1.8 quadrillion asset class. Divide that by the 21 million, and we are talking $85 million per Bitcoin. And again, this doesn't mean the dollar is worthless. This doesn't mean that dollars are no longer here. This just means that Bitcoin has captured value from all the other asset classes. Bitcoin is now the second largest asset in the world, behind real estate. And yes, it's pulled a lot of value from real estate, but we still, turns out need places to live, still need warehouses for our stuff, buildings to meet in. Turns out we still need real estate, but it has pulled value from real estate as well as every other asset that's out there. It's become the denominator. And at this point, the world has decided that we should no longer use the denominator of fiat currency. And at this point, Bitcoin has reached its full and final stage, which is stage 5, and has become the global unit of account. At this point, you no longer measure your wealth in fiat, you measure your wealth in Bitcoin. And at this point, 1 Bitcoin equals 1 Bitcoin. Now, at that point, this is going to sound crazy, but hopefully I've built this foundation for you. At that point, we're talking $8.5 trillion of global store of value assets. Just using the Fed's CBO or the CBO's projections of money printing and a basic historical growth rate, $8.5 quadrillion. If any of you are good at math, divide that by 21 million, and that puts Bitcoin to about $400 million per Bitcoin. And again, this is not speculation. This isn't a dream. This is the 6th time we've seen this exact pattern play out over the last 300 years in an exact repeating process. Over the 50 years, just like the Industrial Revolution, steam engines, the rail, still electricity, automobile, oil, telecom, and now the decentralized revolution. We see it repeating the same time. I'll put the slides up here. They're open source. You can download them. But I want to just leave you with one thing. This is not just a new technology. This is a revolution. And you know that because you're here. So the question becomes simple. Are you going to take advantage and help lead this revolution, or are you just going to watch it pass by? The choice is yours. All right, I'm out of time. Thanks.